Thank you everyone for being here today. A very good afternoon once again. And welcome regardless of where in the world you're from, whether you're from Singapore or Malaysia or Indonesia or anywhere else. Thank you for joining us. My name is Kristen and I'll be your host for today. So I lead the investments team at Funnel, and a little bit of background about myself. I started my career in investment banking in New York in energy and natural resources. And I moved back to Singapore to help build out a biotech startup in the region about 5 years ago now, before I joined Funnel recently, actually not so recently, 2 years ago now, as director of investments. So you can say that I've been on both sides of the table. I've helped companies large and small to raise capital, but I also know what it's like to need funds and have to pitch to investors as well. So if you're not acquainted with us, Funnel is Southeast Asia's largest private investments platform, and we leverage technology and data to curate opportunities in growth, pre-IPO companies for a global network of over 15,000 investors. So before we kick things off, just some housekeeping matters. Later on, towards the end of the session, around 6 o'clock, we'll set aside about 20 to 30 minutes for questions via the Q&A feature. So you can find this button at the bottom of your screen, and feel free to send us your questions at any point during the event, and we'll go over them afterwards. So we'll also be recording this session. And if you have to miss any part of it, don't worry, you'll be able to access a recording after this on our blog. So today I'm really excited to be hosting this webinar, and I'm sure that it will provide some insights into one of the most important and often vexing questions that startup founders face, which is fundraising. So I'll kick things off first with a short introduction to Funnel and how we help companies to raise capital. And I'm also really excited to have Jin Rui with us here today. Jin Rui is from Rajah and Tann, one of Singapore's leading local law firms, and he is a partner at the firm's M&A and venture capital practice. So thank you very much for joining us today. It's an honor to have you here. And Jin Rui is going to be sharing more about the legal considerations around fundraising and how you can set yourself up for fundraising success. Okay, so I'll kick things off first, and I'll start by giving a quick presentation of Funnel and what we do. All right, so Funnel is Southeast Asia's largest private investments platform, as I've mentioned earlier. And our goal really is to build capital markets infrastructure that meets the needs of today's entrepreneurs and investors. So before I go on to show you some statistics about our track record, our credentials, and everything we've achieved so far, I also want to tell you a bit more about how Funnel started. So Funnel was founded about 5 years ago by two former investment bankers, Kelvin and Kylin, who are our CEO and CFO today. And they were at an investment bank at that time. And while they were there, they saw that there was often the same pools of capital that was being made available year after year to the same types of companies. And only companies of a certain size would be able to access these investors and access the fundraising expertise of an investment bank. So what about smaller companies, tech companies, startups, right? So the question really came into their minds at that time: where would these kinds of companies and entrepreneurs find access to capital? How would they even go about fundraising? And what does a fundraising process even look like, right? So I think these are definitely some of the fundamental questions I'm sure that as a founder, you'd find yourself asking fairly quickly in the startup journey, right? After you hire your first few employees, or even hopefully before you hire your first few employees, right? You already have a bit of a plan about how you're going to fund everything. So hence this platform that we have built here at Funnel, where we aim to use technology to really lower the cost that's found in traditional institutions and allow us to serve a new, younger, earlier group of companies and augment the reach that of investors that issuers have today. So we're constantly asking ourselves, how do we connect you with the relevant segment of investors, make the fundraising process easier and more convenient? So this is what we do. We help companies and funds to raise capital and monetize shares and recycle capital later on as well. So on the other side of the table, we have our investor base, who we then tap on for this capital. And these investors range from accredited investors to institutional investors. And they look at a very broad range of opportunities, from primaries to secondaries to funds, across all different sectors. So we have offices in 4 countries today. Our headquarters are here in Singapore. We also have offices and teams in Malaysia, Indonesia, and India as well. In Singapore, we're licensed by the MAS, and in Malaysia, we have an ECF license with SC. And just a little bit here about our track record. Today, our investor network numbers over 15,000. We've completed about 40 deals in the 5 years that we've been around. And deal sizes really vary. It could be as small as about USD 2 mil, all the way to, as you can see here, the largest single direct investment we've gotten is nearly 200 mil, and this is for a fund. So it really varies. We look at companies from pre-A all the way to pre-IPO, mainly because our investor base also has a very broad mandate. So one thing that our investors appreciate about deal flow from Funnel is knowing that we've done a certain amount of due diligence, KYC, on the deals that we show to them. So how do we decide on which deals to take on? So for us, this is a combination of algorithmic screening, as well as human assessment that's similar to an investment committee. And a combination of this helps us to decide which deals to launch with the best chances of a successful fundraise with our investor base. So as I mentioned earlier, we have a lot of different types of investors in our network. About 40% of these are institutional. So you're looking at private equity firms, venture capital, corporate venture capital, family offices as well. And the remaining are individuals, like accredited individuals, or channel partners as well, to whom that we also show deal flow. So as mentioned, we look at a very broad range of industries too. So we're quite sector agnostic. And this is in large part because of the broad mandates that our investors have as well. So a lot of the deals that we have and look at are tech companies, IT companies, a lot of fintech, media, some manufacturing, logistics, healthcare. So we are fairly sector agnostic, and we will look at a very broad range of deal flow. So this is a list of some of the clients that we have fundraised for over the years. As you can see, there is a mix of secondaries, like Gojek, for instance, as well as funds like Hatcher, Vickers, Diamond Asia as well, but also a lot of companies, right? I think the bulk of the deal flow and the deals that we do close are primary deals. So we've got companies from pre-A all the way to pre-IPO that we have helped to raise funds for over the years. All right, so moving on to the question that I get the most from startups. How exactly does Funnel work, and how can Funnel help my fundraising efforts? So our aim, first and foremost, is really to help you to unlock investor access. So we really aim to help startups and founders amplify their investor reach. So I think it's often said that fundraising is a full-time job for founders, right? So the question we are always asking ourselves is, how can we help to broaden the reach of founders so that fundraising takes up just a little bit less of your time? How can we help you go beyond your personal, professional networks and reach the correct subsegment of investors that would most likely be interested in your company? Additionally, we'll also help you to tailor your deal structure in a way that makes sense for the stage that the company is at, the round that it's at, any kind of other considerations or requirements that the company has at that point in time. So we also help with market discovery. So our philosophy is that we're not seeing ourselves as someone who will come in and tell you, hey, we think this is how much your company is worth, right? So we really want to let the market decide, and we want to let professional investors make offers that help you with this kind of price discovery and allows you to get the flexibility that you need to choose kind of the term sheets that make the most sense for you, to choose the investors that make the most financial, strategic sense for you, for where the company is at as well. And last but not least, we also want to help you to optimize the cost of fundraising. And I think this is quite important to us. So typically, we charge a flat 2% fee on funds that are raised through us. There's no retainer, there's no upfront cost. And our incentives are very much aligned with yours to make sure that the deal's closed, money gets into the bank, right? So we really see ourselves as the most cost-efficient way of helping you to amplify this reach to investors. So another question that I get pretty often from founders is, hey, is Fundnel a crowdfunding platform, right? So I think that's something that often deters people from even thinking about launching a campaign with us. So for us, we're quite different from a crowdfunding platform, right? So a lot of founders are concerned that, maybe they'll have 500 investors at the end of the day that they then have to manage. We've given them $1,000 each, right? So it doesn't quite work that way, and I'll show you why. So we really want founders to retain control of the outreach strategy. So that means that any materials that we send out to investors, the whole process is something that we will run by the founders first so that you remain in control of this kind of outreach. So when it comes to deal placement, for instance, founders have the option of having our campaign published on our platform, which of course is a wider reach, or have it be a more discreet, traditional kind of offline placement type of approach, depending on where the company is at. Additionally, there's also options to reveal or conceal the company's name. And of course, there's also the optionality around ticket size. So I think this is quite important. We will go with the ticket size that the founders are typically going out to investors with on their own. So of course, messaging, this is something that we also take very seriously, and we want to make sure that what the founders are telling to investors and what we are telling to investors on behalf of these founders are aligned and also make sense and is really streamlined, right? And still remains very central to what the founders are also saying on their own. And lastly, we also offer a lot of deal marketing help and options too. So often we will work with startups to create virtual roadshows to investors or even educational events as well that really help founders to establish leadership and thought leadership in the space and sector that they operate in. So in summary, the goal is to help founders to reach and engage with more investors in a shorter period of time, and therefore create a more curated and efficient fundraising process. So what does working with Fundnel entail and look like? So this is a quick overview of what an engagement with Fundnel looks like. And we think about it in 4 different phases. So the first phase comes with the onboarding process. And this is when we finalize the engagement, we sign legal documentation, an NDA, engagement letter. We also run the necessary KYC processes that we have to as part of our MAS licensing requirements. And then from there, we will launch the deal. So as part of that, we will do some due diligence on the company. We'll prepare campaign materials for the launch that is required. And we'll also have a discussion with the company when it comes to investor targeting. And this is really dependent on the deal specifications, preferences laid out by the company for us to reach out to the most relevant group of investors for this particular deal. So from there, the third phase would be investor engagement. So post-deal launch, this would be an ongoing process. We can help with data room access, preliminary due diligence. And again, this is something that's quite bespoke and dependent on where the company is at in their fundraising process. And then, of course, lastly, there is documentation and also any kind of closing documents that are required. So overall, the process, I would say, takes about 3 to 6 months from deal launch. All right, so if you are interested to check out our process to raise capital with us, do go to fundnel.com at our Raise Capital page. And there we lay out more steps and an overview of what the fundraising process with Fundnel is like. So if you have any more questions, feel free to put them in the Q&A box and we'll answer them later on. Or also feel free to drop me an email as well. And I'm more than happy to have a discussion with you and see how Fundnel can be helpful. All right, so that is all for the introduction to Fundnel. And now I'd like to hand the time over to Jin Rui. So I'll hand the time over to Jin Rui. And before that, let me give you a quick introduction to who he is. So Jin Rui is a partner at Rajah and Tann, Singapore. He regularly advises startups and founders, VC firms and investors on corporate and fundraising transactions, from early stage, pre-institutional funding rounds to later stage rounds and exits as well. Jin Rui is also a contributor to the VIMA Handbook, a compendium of articles that was launched by the Singapore Venture Capital and Private Equity Association and the Singapore Academy of Law, which provides pointers for startups and founders in early stage fundraising rounds. So we're very fortunate to have Jin Rui here today, and I can think of few people who are better positioned to share some insights into the legal considerations of fundraising. So without further ado, I'll hand the time over to Jin Rui.
Right. Hi, everybody. This is Jin Rui here from Rajah and Tann, and very happy to be here. So I've got about maybe 40 minutes for this segment, and actually there's really quite a lot of things to cover in terms of kind of the legal aspects and issues and documentation with regard to fundraising. I'll try to cover as much as I can, but you know, it may not be possible, and you just have to keep in mind that, you know, every deal, every company is different. There may be nuances and, you know, different circumstances depending on your business, which would affect, you know, the terms and kind of the approach to fundraising. So just keep in mind that this is all just you know, very general, and basically, you know, what to look out for in, you know, the majority of the fundraising transactions that we usually come across. So the format of this, you know, legal issues, I'm trying not to, well, I would definitely not, you know, treat this as a university lecture. I'll keep it casual and, you know, kind of more like a sharing session. So this is really not a lecture to tell you what all these legal terms mean, okay? So that you can kind of leave it to your legal advisor to kind of explain to you if you have one, you know, when you engage one in the course of a fundraising. But these are really things, so what I'll try to cover here will be things that you know, you should look out for even before you engage a lawyer, or where you already have a lawyer, and then, you know, what are things to kind of look out for during the course of the fundraising transaction. Okay, so the outline of this of this session. So I'll be talking a bit about the pre-fundraising preparation. What are the kind of things you need to do in order to get ready to kind of approach your investors and you know, basically to make the fundraising process as smooth as possible. And then what do you do when you get your first term sheet? Next will be the due diligence process that the investor will be carrying out on you. Some key investment terms. I'll go over this quite quickly. There are actually a lot of resources online that you can, you know, just Google what does, you know, this legal right mean and things like that. And there are a lot of kind of articles online that explain, you know, different variations and you know, what should founders ask for or negotiate, you know, when they are kind of finalizing the documentation. And lastly, just generally what the legal documentation involved in the fundraising. Now, so pre-fundraising preparation, this is when, you know, you decide that you're ready to kind of bring in an institutional investor. You kind of go out to start talking to VCs and you know, there may be interest in investing in your company. But first and foremost, there are a few things that, well, and at this stage, you probably wouldn't have engaged, you know, legal counsel yet. So there are a few things that you as a founder will have to prepare on your own, well, together with your team. The first thing that's very important for everybody, both for yourselves as well as your investor, would be maintenance of your cap table. You should, you know, maintain this very kind of religiously. Every time you receive new monies, whether, you know, from friends and family, or, you know, you may have raised safe notes or care notes, you know, prior to this first institutional round. Be very aware, and also you may have also, you know, issued certain equity incentives to your employees or the founding team. So you have to be very clear as to, you know, what your shareholding cap table looks like. So cap table, basically, it's a table which shows, you know, who are your shareholders, who are your investors, what's the investment instrument they hold. Is it ordinary shares, or is it, you know, certain other classes of shares that you may have created, you know, during your seed round, or you created a different class of shares for your employees, or whether they are convertible instruments like your safe notes. And not just that, the cap table will also show what's the fully diluted or the converted shareholding of the company. Meaning to say that if everybody were to convert into the same class of shares, what that percentage of ownership that each shareholder will have. So this is something that, you know, investors this is the most important point, basically, to see who's in your company. And why you need this is because when the investors, they invest in your company, you need to know your valuation, how much they're coming in at, the investment amount, and how your cap table will be affected and how you'll be diluted. So if you as a founder, before this fundraising, you hold maybe 90% of your company. After the fundraising, how that cap table is going to change, especially where you have one lead investor with multiple investors, and, you know, different investors are going to subscribe for a different number of shares. Number two, corporate records. And material contracts. So these are really your kind of I'll go through the corporate records first. So I would assume that most founders, you would probably use one of those low-cost corporate secretarial providers. There are quite a number. I know that I think Sleek is actually one of the more popular ones, because it's really no frills, very low cost, and they kind of help to maintain all your basically corporate records. So it's like directors' resolutions, your AGM minutes, your register of your various registers, like your registers of transfers and allotments and things like that. So so before the due diligence starts, you have to have all these documents ready. Preferably, you would have kept them in a cloud drive like Google Drive or Dropbox. And during during the due diligence by the investor, you just give access to the investor to kind of look through all these documents. So don't scramble last minute when due diligence starts, and then the investors are asking for this and that, and then you have to kind of try to look through your emails and ask your team, do you have this document or not. Other preparation would be, okay, founders agreement. This is not so much preparation. An item to be prepared. You may or may not have a founders agreement prior to your fundraising, but in any case, this would very likely be superseded by the shareholders agreement that the investor would be signing up with the company and all the other shareholders of your company. Employment agreements. Well, this is also one of the kind of items that founders kind of may miss out, because the company is just, at least for those that you have not taken any money yet and you're going straight to your first institutional fundraising round. There are founders that they don't enter into employment agreements because it's really just them as the only shareholder and only director of the company. But from a legal perspective, there is a distinction, whether you are an employee, a director, or shareholder of your company. So at this, for early stage companies, it may not make sense to kind of, go to a law firm to kind of get a lawyer to draft an employment agreement for you. There are templates online. I wouldn't say just, go online and just download one and just fill it up yourself. But but in reality, that's what most founders do. They really just go and download something. So but the important thing is that to kind of have one of this which will set out kind of your key employment terms, like what's the salary and notice period and things like that. IP. So these are so this will apply mainly for companies where the founder has actually started creating or creating an IP, be it in an app or program or platform, website, things like that, even before the company has been incorporated. So, from a legal perspective, the company and you as a founder, you are kind of technically separate entities. So whatever is owned by you, so if you create an IP, you'll be owned by you. But prior to, during the course of due diligence, the investor would want to ensure that whatever IP that has been created is being owned in the name of the company. And lastly, structuring of the group. So this may or may not be applicable to your startup. The idea is that generally it is better to kind of split up your company into various subsidiaries, depending on kind of the jurisdiction that you do business in. Understand that this may not be feasible due to cost concerns for early stage startups, but this is something that you want to keep in mind. Another point about structuring is where you may have taken on a lot of shareholders who are like your friends and family or your angel investors, and you kind of have a very long cap table. So there are a lot of shareholders that may actually hinder future fundraising. So in some cases, the founders may actually create a separate vehicle to house all the angel investors or like all the employee shareholders into one vehicle, and then have, certain governance structures in order for those angels or employees as a class to kind of exercise their rights over those shares. So all these points that you see on these slides, these are not kind of items that you have to do before you go to your fundraising, because in all likelihood, there may be issues uncovered by the investor when they're doing their diligence on your company. So for example, if they see that, that your employment agreement is not adequate, it's kind of like very bare bones, or maybe it's not compliant with Singapore law, things like that, or whatever country, the laws of whatever country that you have signed the employment agreement, then as part of the fundraising process, the VC or the investor would also suggest, or actually they will make it a condition for you to rectify all these issues, as part, either as a condition precedent or to take effect when they fund you. So that's on fundraising. On fundraising preparation. So generally, this is kind of the stage of the transaction. The investor, you speak with the investor, they do their initial due diligence on you, and then you may receive a term sheet. That's at stage 2. Following which, after signing the term sheet, investor will carry out their due diligence. And then the next stage would be basically your transaction documents or your investment documents. So these are the legal documentation pursuant to which the investor would basically invest their money in you, and also the shareholders agreement which will kind of govern the rights amongst the shareholders and the investor and the company. Stage 3 and 4, this may be concurrent, depending on kind of the urgency of the deal, or it may very well be, kind of after the investor completes its due diligence, then they kind of offer you the first draft of the investment documents. And the last stage would be the closing, which is where they give you the money and you give them the shares. Now, getting your first term sheet. So this is the most common question. Do I have to look for a lawyer or not? Well, the answer is it depends. Sorry, this is very standard lawyer answer. Whatever you ask a lawyer tell you it depends, but sorry, it really depends. So the main consideration here would be the cost. As an early stage startup, cost is always major concern. The thing is that it is possible to kind of DIY yourself, meaning you read the term sheet, you look at the terms, and then if you're happy with the terms, you sign it. It's possible, but of course, if you don't feel safe, you can engage a lawyer to do kind of like a high-level review. So basically, they'll just kind of comment on any red flags with the term sheet, or to do a full review. Full review, I don't think is necessary, and it's really not common at all, unless you are really, really, just you don't feel safe and you just want someone to kind of cover all bases. DIY or high-level review, that's usually the most common. And now I'll tell you how you can kind of DIY it to save cost on this at this stage. So there is this set of documents called the VIMA documents. So this is actually kind of like a standard template investment documents. It's actually an initiative that was launched by the Singapore Venture Capital Association in conjunction with Singapore Academy of Law. So what this represents is really just kind of like a standard template. You have your term sheet, your subscription agreement, your shareholders agreement, which would already set up kind of a balanced draft, which kind of reflects the market terms. So, so the thing is that if you receive a term sheet from an investor, I think one of the first thing you can do is go to the VIMA website. You just download and you can kind of see what are the terms inside the VIMA term sheet. And from there, you would be able to kind of compare, what terms or what rights the investor is asking for, or what rights that they have kind of not asked for. So when the SAL and the SVCA, they kind of term it as the kind of the market standard. So that was actually derived after consultation with various VC funds, some founders, as well, some founders and also startups that already have gone through rounds of their fundraising, as well as various law firms which have done many of these deals. So they would have seen a very wide range of deals and the terms that the investors have asked for. So the idea of this VIMA is actually really to save time and legal cost, because it will kind of represent a document that would be, I would say, maybe 70 to 80% complete, and the rest is really just negotiation of kind of the key concerns or key rights that the investor is asking for, or which you as the founder want to have. So when you kind of have your discussions, kind of having discussions with the investor, right? Do broach the idea of using the VIMA documents as your kind of the base document, the base template to use. Because actually most VC firms, they would actually be quite familiar with the VIMA documents and what are the rights that are set up in there. And also, you as founder, first time coming across all these legal terms, the VIMA template actually sets up there are a lot of footnotes in the various clauses, which provides kind of a very brief overview or explanation of what these terms mean and what are the kind of common variations that investors or you as founders may ask for. So that's kind of a useful guide that you can refer to when you are reviewing the term sheet from the investor. So together with the VIMA documents, there's also this VIMA handbook. So it's really a kind of compilation of articles which kind of explain the fundraising process and so various aspects, legal aspects of running a startup. So do take a look at that and have a read. If there's anything that's unclear to you, actually you can just Google further, and I'm sure you'll find many more articles explaining to you what these rights mean. So after, or actually concurrent with or after signing your term sheet, investor would be carrying out their legal due diligence in your company. So okay, first point on NDA. Well, you may or may not ask the investor to kind of sign an NDA. I would say it's not very common, and VC funds, they do deals day in, day out. They don't really usually sign, NDA for every single deal that they, that they are doing due diligence on, unless there are very kind of strong reasons. And how this due diligence process work is that they would engage an external law firm. The lawyers would prepare a set of questions or checklists, and they will send it to you with all the kind of documents, information, and details that they want to see, and which you would then either send it to them via email, or you can just upload everything on a cloud drive like a Google Drive or Dropbox. And this is where it kind of ties in with that, preparing for the fundraising, where you already have all your documents stored at one place, and you can just kind of give access to the VC lawyers to kind of carry out their due diligence. Okay, the other parts of the term sheet, well, there are a lot of commercial terms in there. You can go to kind of download the VIMA standard template and then kind of take a look at how the term sheet would look like. But so commercial terms, these are all the very important terms that would be reflected in the legally binding documents. So I mean, I won't go through all of them here. I will go through the kind of the key terms later on in this session. But just note that there are all these commercial terms in there, and there are also some of the legal terms which I will kind of just briefly go through. So one thing to look out for is to see whether the term sheet is expressed to be binding or not binding. And it should be non-binding as to the commercial terms. So things like, well, okay, maybe, valuation, all these things, it's kind of very hard to change after you sign the term sheet and agree with the investor. But things like, the other rights that the investor has, or, the rights of the preference shares that they're subscribing for, there's still leeway to change later on. So just look out for that and make sure that the term sheet is non-binding. Exclusivity provision, sometimes investor may have that. So basically what it means is that after signing the term sheet, they don't want you to be talking and looking for other investors, for a period of maybe 30 days, 45 days after you sign, because they just want you to kind of focus on closing the deal with them. So do look out for that. Because then you shouldn't, if you sign a term sheet, then it is very likely that the standard template term sheet would actually say that this exclusivity provision is legally binding. So so if, let's say, you already signed a term sheet, but you're still going out, entertaining other investors, that would be a breach of the term sheet. But then again, whether the VC fund actually, sues you for kind of a breach of the terms of the term sheet, that's a separate issue, which is unlikely. But then it will kind of, you get a bad name. Yeah, if you do that, because actually VC, that the network of the investors, they're actually quite closely knitted. So, they do talk to one another. Okay, next point is on expenses. So in the term sheet, it is very common that the VC will basically ask you to reimburse some of their legal costs for preparing the legal documentation. So just take note of this. The amounts, it varies. It really varies from VC to VC, and also highly dependent on what the round size is. If you're going to raise 1 million or 2 million, and then they're asking for kind of like a $50,000 reimbursement, that would be too high. Usually, I wouldn't say for all cases, but then usually what you see would be in the range of maybe $20,000 to $40,000, which would be deducted from the investment amount that they are going to put into your company. And lastly, another point to look out for will be on the warranties. So basically, warranties are this set of factual statements about the company that you have to give in the subscription agreement. And what to look out for is whether the founders are also expected to stand behind these warranties. For early stage companies, it's actually very common for the founders to give the warranties as well, because really the company has not much substance in the event that if there's a breach of warranties. And really, the only people who know the startup inside out are the founders. So it is common for founders to give warranties, but of course, there are cases where founders have strongly pushed back on this, and investors have accepted that. So joint and several, this is a legal term, but basically what this means is that if the company breaches any of these warranties, then the investor can either sue the company or sue the founder for that. So the founder in this case would, incur personal liability if you give any statements that or warranties that are untrue or inaccurate. Now, I'll go through quite quickly on the key VC terms, or basically these are the terms that you will see inside the shareholders agreement. But I won't go through in detail. I won't go through them in detail. So basically just letting you have an idea as to what are the terms that you see inside the shareholders agreement, and very likely all these terms will appear in the term sheet as well. Okay, so and also what I'll do over here is also basically to kind of tell you what are the key aspects of these terms to look out for. So board seat and observer rights. What is important here, I think for early stage companies, still not so much of a concern, because very likely founders still retain control. You have a team of maybe 2 or 3 founders. Probably you give one board seat to the investor and then you still maintain control. So this is very straightforward. It's only when you get to your C round, B rounds, or you do multiple kind of bridging rounds where investors each ask for a board seat, then you would have to kind of keep in mind as to whether this would hinder your kind of day-to-day management of the company. And okay, second point, I think for early stage companies at the end of Series A, founders should, you should still expect to retain a majority of the board. Information rights, there are this quite, it's not a very controversial issues. Investors, they may have their own kind of requirements as to what information you have to give them. But likely this would just include your audited financial statements, management accounts, maybe quarterly management report, and then your business plan, annual budget, things like that. Next point on reserve matters. So reserve matters, these are so as I earlier mentioned, founders, you would still continue to hold majority of the shares and majority of the board. So in effect, you would have control over quite a long list of kind of the transactions or matters that the company will undergo. So to kind of protect the investor's position, there will be a list of reserve matters. So these are matters that you as the founder, notwithstanding that you have majority of the company and have the kind of the right to carry them out without the vote of the investor, these are the matters that would require the consent of the investor. So when I say investor, it really depends on what this veto right or consent right threshold is. There are variations to this. For example, they may require a majority of your Series A shareholders, or maybe only require the consent of the lead investor. So when you're looking at this, just do keep in mind to see whether this would actually hinder any of the kind of matters that you want to undertake, in particular future fundraising. Deadlock. So in the context of startup with multiple shareholders, if there's a deadlock, so deadlock would usually arise when the investor does not give its consent to the reserve matter that you want to undertake. So very often it would just be kind of status quo. So you just are unable to carry that out. Okay. Next, I'll go into preferential rights. So these are the rights attaching to the preference shares that the investor would be subscribing for. First one will be dividend preference. For early stage Series A, not very common to kind of have cumulative dividend. So cumulative dividend basically just means that there is kind of like a notional kind of interest rate on the shares, on the investment amount that they've invested in you. So for example, if there's a cumulative dividend preference of, maybe for example, 3% or 5%, that's kind of like an interest rate whereby if in future you distribute dividends to the shareholders, then the investor would get kind of the preference to receive all the interest that has accrued on their investment. So for early stage companies, not very common to have dividend preference, whether cumulative or non-cumulative, because in any case, the company is unlikely to be profitable at that stage. You're still growing, likely your accounts are still red, and really there's not much, there won't be any dividends to talk about. So usually VCs are not too particular about this point. Next point, liquidation preference. This is kind of the key downside protection that VCs have. So just keep in mind these variations to the liquidation preference. Where I wouldn't go through all what all these terms mean. You can kind of it's all in the VIMA handbook or the VIMA term sheet as well. So you can take a look at that. But basically what this liquidation preference is for the is basically in the event where the company winds up or where there's a liquidity event. For example, where there's a trade sale, you sell all the assets or the business of the company, or if a majority of the shareholders sell all the shares in the company, then the investors would want to have their investment returned to them first. Yeah, so it's kind of protecting. So they have first dibs on getting back what they've invested in you, and any remaining amount, if there are any, would then be distributed amongst either all shareholders or just only the ordinary shareholders. Also do take note of what the multiple is. Most likely it would just be a 1x of the investment amount. But in some cases, VCs may try to ask for something more, maybe even up to 1.5x, but it's not very common. So just keep that in mind. Even so, anything above 1.0x is really not common. Yeah. Next thing is flat stack versus waterfall. Okay, this is more. I think this will be more applicable in Series B and Series B onwards, where you have different classes of preferential rights. Different classes of preference shares. So this is really just whether the later stage investor gets back their investment first, or if all investors kind of get back their investment together at the same time on a proportionate basis, and then whatever remainder gets shared amongst the remaining shareholders. There would be anti-dilution rights. So basically these are rights which protect the investor in the event where you do a down round in your subsequent fundraising round. So basically you are fundraising at a lower valuation in your next round. So what will happen is that instead of one preference share converting into one ordinary share, these investors would have an adjustment to this conversion price or conversion ratio, such that each preference share would entitle them to a greater number of shares, ordinary shares, if the preference shares were converted. So what to take note here is that there are actually really only 2 or 3 main variations here. It's the weighted average. It can be broad-based or narrow-based, and the other one will be full ratchet. So what is kind of standard or market for Southeast Asian deals would be a broad-based weighted average. So anything that is not broad-based weighted average, i.e. narrow-based weighted average or full ratchet, these are more beneficial to the VCs and it's not market. So unless there are really compelling commercial reasons for them to ask for it, you as founders should try to resist giving anything other than a broad-based weighted average right. Okay, nearing the end, so there are other rights in the shareholders agreement and the term sheet. So these are rights relating to kind of the treatment of the shares that the investors hold. So, okay, first point, founder lockup. There may or may not be a lockup of your shares, which means to say that once they fund you, the deal closes, they may want to lock you up for a period of maybe 1 year, 2 years, and which may which may tie in with kind of a vesting schedule for the founders. This really depends on the VCs, and it's really negotiable. So for this, I wouldn't say there is kind of like a market standard that applies across all deals, but you just be prepared that there may be a lockup of your shares. Preemption right, basically this just means that if any VC wants to exit, what would be the procedure? Very common, it's going to be a right of first refusal. There may be variations to this, for example, an over-allotment right, or it's a right of first offer instead. But this is pretty standard. So founders and VCs usually don't spend too much time kind of negotiating on preemption rights. But one thing to take note is sometimes VCs, they ask for the preemption rights to only apply to transfer of ordinary shares. What this means is that if you as the founder, you want to sell your shares, you have to offer to them first. And then you have to go through, offer to them for a period of maybe 21 days and some or something like that. And then, they give you a price and then you go out and look for a buyer, but you cannot kind of sell at a lower price than what they offered you. So the thing to take note here is that it's very common for your shares to be subject to the preemption rights. But what you have to take note is to make sure that the investor shares are also subject to these preemption rights. So kind of, you from your perspective, you try not to let them have free rein to, exit or transfer their shares to anybody they want or any buyer that they can find. Last two rights, tag along and drag along, these usually come hand in hand. What this means is that if there is, so for drag along, if there is a change of control in the company, or if there's, so if there's a buyer who wants to buy, for example, more than X%, usually it is more than 50% of the company, then basically the selling shareholders who are selling the 50% can force everybody else to also sell to that buyer. Similarly, the tag along works conversely. So where the majority, so if shareholders holding more than 50 or X% of shares want to sell their company, then every other minority shareholder gets to exit. What to take note here is that for tag along, there are two kinds. Sometimes there may be a kind of a pro rata tag along for any transfer of shares. So what this means is that if any shareholder wants to transfer their shares, it means that every other shareholder will get the right to kind of also sell their share to that same shares to that same buyer on a proportionate basis. And then you have your full tag along rights, which is basically every other shareholder gets to sell all their shares where there is a buyer who wants to acquire more than X% of your company. So what is going to be negotiated here would be basically who gets to tag. It should be all shareholders. Sometimes the VCs might restrict this to only investors having the right to tag. So there are variations. So when you review the contract or the agreement, do kind of take note and check with your legal advisors as to what the document actually provides for. Other exit rights, this may or may not be at the Series A stage, more common for kind of the mid to later stages where kind of the investors are all looking at kind of a fixed term exit. They have a horizon by which they have to exit the company. And if there isn't any, then they may have the right to kind of force the company to exit, whether by way of IPO or trade sale. For A stage, not so common, but sometimes the investor may ask for it. So just take note of that. Okay, this is the last slide. So these are the kind of the legal documents that you would expect to see in the course of the fundraising transaction. For term sheet, as I mentioned earlier, you may want to do it yourself if you feel comfortable enough. But feel free to kind of discuss with your other founders or actually people who have gone through a fundraising before as to what you're offering is kind of standard or not, or whether there's any other things that you should look out for. For share subscription agreement, shareholders agreement, and constitution, I think for this, it would be more advisable to get a legal advisor on board, because then your kind of lawyer will be able to review every single clause to make sure that nothing sneaky has been put inside by the investor. And again, just to remind you, the VIMA documents, they contain the entire suite of transaction documents. So if possible, you try to ask the investor to use that as the base draft, which would really save everybody a lot of time and legal cost as well. And with that, I've come to the end of my sharing session. So, Christine.
Great. Thank you so much, Jin Rui. Really informative and definitely a must learn, right? I think for a lot of founders and entrepreneurs as well. So that was super comprehensive. Okay, we've got one question here. So how much bargaining power do companies have in negotiating the terms in a term sheet?
Well, okay. I think this
It's
really
intense answer.
I think this really depends on really how much you want to, or how urgently you need to close the deal, or how urgently you need the funds, because if you, or really how desirable this VC is, and how much value you think that this VC can add to your company. For some companies which you are kind of in a very you're in a very niche space, there's really clear scalability, and you really have all these big, even VCs coming to your company, even at the kind of pre-A or seed stage, and then you actually have more bargaining power, especially where you already have some investors on your cap table, and you're doing your A round and you're negotiating with the lead investor. Really, sometimes you can just use those investors to kind of push back on a lot of these terms to say that these existing investors are not agreeable to whatever the lead is asking for. Yeah.
Yeah, I definitely agree. I think the bargaining power ultimately depends on how much of a position of strength you're coming from, right? So if you have a lot of suitors and a lot of VCs who are kind of courting you, then definitely that's going to give you a lot more bargaining power. So yeah, I think it definitely depends on the position that the company is in as well. So one more question for you, Jin Rui. So from your experience, having seen these companies, and I think also because you've seen companies at various stages, right? You've seen them at sort of like a Series A stage, fairly early, but also later on, kind of like the Series CD and so on. So from your experience, what are some of the biggest pitfalls that you have seen these startups make? Both at an early stage as well as things that sort of come to haunt them a little bit later on, right? That ideally they shouldn't have done in the first place.
Right. Okay. So I think at least for early stage companies, one thing you have to keep in mind is that whatever rights you are giving to your Series A lead investor and all the other Series A investors, that will come back to haunt you at your later stages, because then your B investors, C investors, they will be looking at what you've already given to your Series A investors, and they'll say that, hey, look, you've already given them all these rights. Basically, I want the same rights or more, or in a kind of in priority to that Series A. So if you are kind of stuck in a very bad position at your Series A stage, that's gonna kind of trip you up at your later stages, because that's gonna affect your kind of your bargaining position when you are asking, to get back certain rights, or where you're trying to push back on certain rights that the investors, your B or C investors are asking for. So that's one of the kind of that's one of the issues that I can think of right now. I think one more thing to take note when you are kind of negotiating with your investors, and this is very common, it comes up in a lot of negotiations, is your investor will tell you that, hey, look, this is market standard. But the thing is that this concept of market standard is a very elusive concept. It varies from person to person, and it really basically kind of changes depending on who you are, whether you're the investor or the company. So when the investor tells you, look, I want all these rights, it's market standard. Everybody gives that. The thing is that, okay, this is not an argument. This is an observation. So you shouldn't kind of feel that, you are pressured into giving this because they call it market. If you're unsure, you can ask around your other founders. I'm sure all of you, you have kind of your own network of founders, and people would have done fundraising before. The thing is that just don't be taken in by this concept of market standard. You can refer to kind of what's inside the VMA template to see what's the balanced position. So I think that is kind of one of the resources that you can kind of refer to, when negotiating for certain terms. Yeah, but just keep in mind that every deal is different, every founder, every company is different. What is standard for a type of company or for one VC may not actually apply to all transactions.
Right. So one more question here that I think maybe you've touched on a little bit as well is, how do I know which terms in a term sheet are common? For example, it seems strange to me that the VC's expenses are borne by the startup.
Right. Okay, the thing is that for VCs, when they give you their term sheet, very likely they would already have their own in-house template. And VCs, they really, there's so many out there around in Southeast Asia, and they do so many deals, day in, day out. The terms that you see, most of the time it should be common, but I'm sorry to keep going back to the VIMA, but really that's something that's free and available for everybody. And it was prepared with input by both VC funds as well as founders, as well as law firms. And the idea is to have kind of like a 50-50 balanced approach that balances the rights of the investors and the founders. So you can look at that to see what is standard or not. For the expenses, it depends on whether it depends on firstly the VC. Sometimes they may ask for it, sometimes they may not, but they may ask for it, especially where they'll be carrying out legal due diligence. So in your Series A round, if your lead investor asks for expenses to be reimbursed, it is not uncommon. What is uncommon is if your other minor investors who are also joining in your round are asking for expenses to be reimbursed. That's uncommon. Another uncommon reimbursement scenario is where your existing kind of safe investors or your convertible instrument investors, they may engage their own external lawyers to kind of review the shareholders agreement or the terms of the Series A shares that they are converting into. That's not very common also. So really the only expense that you'll be reimbursing would be for the lead investor. But then again, this is something that's negotiable. If you don't like it, tell the VC and then have a discussion, and they'll see how they can accommodate.
Definitely. Thanks for that. So one more question, I think this is a good question. Is VIMA a standard across VCs in Southeast Asia? And I think this also relates to a larger question around what you've seen around regional differences, right? Given that nowadays you could have an investor from Singapore, an investor from Indonesia, how have you seen those kind of like cross-border differences come into play when it comes to the legal agreements?
Right. Okay. So I think for VIMA, the thing is that a lot of so firstly, VIMA is actually a Singapore law governed document. So it really what you use it for would be you can basically just download it and use it for a Singapore company. If you're going to use it for an Indonesian company or for a Malaysian company, then you would have to seek local lawyers to kind of adapt that agreement to such that it applies to a local company. But with that being said, the key preferential terms and key rights, they are generally the same. So, the thing is that, for a lot of all this, Indonesian companies or companies that have operations in Vietnam and Thailand, or Philippines, it's actually very common that they use a Singapore holding company with no business at all. So they really just have a Singapore holding company, no employees, no assets, nothing. The only purpose is to hold shares in all these subsidiaries. So that's something that's very common, even for example, in like an Indonesian VC investing into an Indonesian company, because the thing is that for Singapore company, it's the fundraising process and all this corporate company law, it's all very kind of very efficient, very pro business, pro investor, and it's easier to market to investors across the region. Sometimes you may get this a couple of investors, they may want you to flip into a Delaware holding company, but really if your kind of your operations are in Southeast Asia, very common you use a Singapore holding company, especially if you're going to scale into other countries in the region. But and also even so, you'll be able to refer to the VIMA as kind of like to look at the substantive terms to apply to to whichever country that your company is incorporated in.
Got it. So there's one question from a registrant when they first sign up for the webinar. And the question is, how do you calculate startup valuation for investor pitching purposes? So I think this is probably something that a lot of founders encounter as well. And maybe I can take a first step at that. I think because most startups are fairly early stage, I think things like DCF, for example, doesn't quite make sense. So a lot of times, I think a multiple is definitely a good way to go. So a multiple of sales or some kind of revenue figure is typically what is used. But again, I think this goes back to sort of what we talked about in the first question about things like bargaining power, how many VCs are interested in you, and so on, right? So things like valuation, for example, is definitely relative. If you were the same startup, same business in Singapore versus same startup, same business in the US, your valuation is going to be markedly different. So ultimately, I think the way to think about startup valuation is I would highly recommend talking to as many people as possible and getting their sense of what they think about your valuation, right? So then you'll know what is quote unquote market standard in all these different people's views and whether or not they think that there's a valuation that is defensible, right? When you go to a lot of different investors. Because I think the other thing to consider is that if you start off with a valuation that is too high, sometimes it's difficult to get the VC or the investor to come back and look at the deal again, even if you lowered it, right? Because it then presents a negative market signal. So I think that is something that is a little bit of a chicken and egg for sure, but definitely talk to other founders, talk to VCs, talk to advisors, and get as much advice as you can about what the market might think about your valuation and think about your startup from that perspective. So, and ultimately, of course, it comes down to finding someone who's able to give you a term sheet and agrees with that valuation, right? So ultimately, that's the most important thing. Any views on that, Jin Rui?
Yeah, I mean, for me, I'm not the numbers guy. So usually, the founders would already have agreed on the valuation with the investor before you even come to the lawyer. So we don't really kind of get to see, how the conversation pans out. But really, it boils down to two things. Okay, I mean, in my personal view, valuation is not science. So there's no kind of hard-coded formula, how your company should be valued. At the end of the day, it boils down to how much, what's the percentage of the company you're giving away, because and how much you want to raise. So then your valuation will determine, what's the proportion of that's represented by the investment amount that the investor is putting in. So if the investor is asking for 40% at your Series A, that's really kind of high. So then you kind of have to reconsider that, whether that valuation makes sense and whether you need that much money. If not, then you can kind of ask for a lower investment amount.
Yeah, definitely. And I think these are, again, things that can easily be Googled. I think there's definitely a lot of information out there about, ideally, this is how much you should be diluting each round and so on, right? So that's also another way to kind of think about it. Great. So I think there are no more questions. And I think that's, one more question. How does Funnel make money? Okay, great question. So we charge a 2% success fee typically on funds that are raised through us. So our incentives and how we make money and our economics are very much aligned with the founders and the startups. So for us, if we don't close a deal for you, we don't make money, right? So it's quite simple. We don't charge anything upfront and there's no retainer as well. Another question is, can we get legal advice through Funnel? Funnel does not provide legal advice to the startups. Of course, we are able to refer you to lawyers and people that we work with who might be in a better position to do that. So yeah, that's something that we would have to refer you to someone else for legal advice. Okay, great. I think that's about all the time we have for today. Thank you very much, Jin Rui, once again for your time and your valuable insights. Thank you to our audience for your great questions and really appreciate you taking time to be a part of today's webinar. And as I mentioned earlier, a copy of this recording is going to be up on our blog, and we'll reach out to share that with you in the next week or so. And lastly, if you'd like to keep abreast of what Fundnel is up to, please follow us on LinkedIn at Fundnel. And we'd love to keep in touch. Thank you, and we hope to see you at our next virtual event. Thanks so much, everyone. Have a great evening.